Well, there's a couple ways to think about the supply chain disruption. We use that terminology a lot. There's the real economy, and clearly there's been problems. And I had conversations with CFOs, CEOs in the spring. They were already raising this issue about the backlog in the Port of Los Angeles and Long Beach, and the trains and the trucking distribution. So that has been sort of well understood in the market, and how far into the future this was going to be discounted back. It is certainly a concern that we have on the fundamental side. But thus far, the results coming in so far on the consumer confidence, the idea of balance sheets, you heard from some of the banks earlier this week, is really pretty optimistic in terms of the business activity. Clearly, the lack of supply and some of the issues are certainly there. But you think of another way of supply chain disruption, think about it in the financial markets. There's been $240 billion of capital that's been issued this year, both IPOs and follow-on equity offerings. And there's been a roughly similar amount of inflow into the market. So I would argue in the financial markets, certainly in equities, that's been matched off pretty reasonably, supply and demand. And then there's this huge amount, now almost $900 billion of authorizations and sort of executions on share repurchases. So we think about the supply demand in the financial markets. That's an aspect that you need to keep in mind as well.
David, you mentioned tax reform, and I'm curious, have you begun to try to model what earnings will look like next year, perhaps, if we do get, for example, and we don't know, I know that, but a rise in the corporate rate here in the States, and as importantly, perhaps, that global minimum tax of 15% that may also take effect in some fashion, and certainly would hit some of these big growth companies we all know well that pay very little in taxes in places like Ireland?
David, it's an excellent question. Yes, with my colleague Ben Snyder, we've done lots of work modeling and thinking about the tax implications around the variety of proposals. And the assumption that we are currently making, it's incorporated in our forecasts, is that you'll have around 25% sort of federal statutory rate on the corporate income tax rate. We do have an assumption on the international tax rate as well. And the bottom line, David, is we are assuming only 2% earnings growth next year. That is a pretty modest, pretty muted level of earnings growth. And a lot of that is a function, or a lot of the fact that it's quite low is a function of tax reform. If you didn't have tax reform, kind of posit a different scenario, you had the static tax law today and sort of persist into next year, we'd have earnings growth something on the order of around 7%. So another way of thinking about this, it's about 5 percentage points headwind in terms of earnings growth. But again, that's something that will affect different companies in different ways. But we are assuming that, and that's part of our model. And thinking about what's the market today trades around 20 to 21 times a forward multiple. Bond yields are now at 1.5%. We're assuming that they climb a little bit higher to around 1.6% at the end of this year. And that would be supportive, in our view, of around 4,700 for the S&P 500 this year. And that would be another 6% or so upside from the current level. And then next year, however, a relatively more modest upside, and that's 4,900 at the end of 2022. So if you want to think about that, David, it's like 10% return over the next 15 months is kind of generally in line with where earnings are going, although it'll be a little bit shallower next year because of the tax headwind.